All right, welcome. We live in a world that's just drowning in data. We see companies everywhere reporting on their ESG efforts, environmental, social, and governance. But let's be real, how do we get from these abstract numbers to what actually drives a business, its financial value? Well, today we're going to break down a framework that does just that. We're talking about translating sustainability data into actual dollars. So let's just start with a question. A company reports it used 1.88 cubic meters of water for every ton it produced. Maybe they even say that's an improvement from last year. And on the surface, you might think, okay, that sounds pretty good. But what does it really tell us? Is that efficient compared to their competitors? And here's the kicker. Was this water used in a region with tons of rain or one that's facing a drought? Without that context, the number is just, well, it's a mystery.
And that really gets to the heart of the problem, doesn't it? A standalone ESG number, even one that seems to show improvement, just brings up more questions than it answers. It's the classic situation of having a lot of data, but not a lot of information. For any kind of serious financial analysis, a number like that without context is pretty much meaningless.
I love this analogy because it's just so on point. Think about it. You would never, ever look at a single line on a company's balance sheet and say, yep, I understand this whole business. Of course not. You analyze it in context. You compare it to other figures. You look at past performance. And sustainability data is exactly the same. To figure out what it truly means, you've got to give it that same level of rigorous, thoughtful analysis.
Okay, so where do we even begin? Well, the very first step is to figure out what actually matters. See, not every ESG issue is going to have a big financial impact on every single company. The real key here is to pinpoint the issues that are financially material for that specific business, in its specific industry. And to find what's material, we basically have to look in two directions. First, you look inside the company, at its own operations. How does it make money? What resources does it depend on? And then you look outside, at the world it operates in. What's the geography like? What are the regulations? What's the overall business climate?
And this table just illustrates that point perfectly. Take a look at these two electric utility companies. Company A makes money from selling electricity and from transmission services. But Company B, they only sell electricity. So a sustainability metric about, say, the efficiency of transmission lines is super important, financially material for Company A. But for Company B, it's completely irrelevant. Same industry, totally different realities.
So, once you've figured out what's material, the next big challenge is making all that data comparable. I mean, a huge company is almost always going to use more energy than a tiny one, right? But does that automatically mean it's less efficient? Not at all. We need a way to level the playing field so we can make a real, honest comparison. And that leveling process has a name. It's called normalization. It's all about adjusting the data so you can compare apples to apples. This is so important because it shifts the question from how much to how efficiently. And that allows for a true comparison of performance, whether it's between companies of different sizes or just looking at one company over several years. This is just a fantastic example of normalization in action. You've got an internet company and a beverage company. They both use 10,000 gigajoules of energy. In absolute terms, they look identical. But that tells us absolutely nothing. It's only when we normalize the data by a metric that's relevant to their industry, search queries for one, hectoliters of booze for the other, that we get a totally different and way more useful picture of their energy intensity.
So, what can we use to normalize data? Well, it can be production units, like we just saw. Or you can use familiar financial metrics. Revenue is a really common one. Another powerful metric is EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Using EBITDA is really effective because it gives you a clean look at a company's core operational profitability before all the financing and accounting stuff gets layered on. When you normalize by EBITDA, you're essentially getting an idea of a company's environmental impact relative to its ability to generate cash. It's a great way to tie sustainability directly to financial efficiency. And now for the most important step of all. We've found what matters, we've made the data comparable, so how do we actually translate this into dollars and cents? We do it by mapping that sustainability performance to the core channels that actually drive a company's financial value. And there are really three main ways this happens. First, sustainability performance can hit a company's income statement directly through revenues and expenses. Second, it can impact the balance sheet through the value of its assets and liabilities. And third, it can influence the company's overall risk profile, which in turn changes its cost of capital.
Let's start with revenues. Imagine a company that gets a high percentage of its sales from products that are certified as sustainable. Well, they are likely tapping into a growing consumer demand. This isn't just a feel-good thing.
It's a direct driver of market share, it can give them pricing power, and it fuels future growth.
Or let's think about expenses. A company that works to reduce its total energy use isn't just being green, it is directly lowering its operating costs. That means better margins, better profitability. It's really simple. Efficiency gains are financial gains.
What about assets? Picture a coal company. As climate regulations get tighter and tighter, the value of their coal reserves, which is a huge asset on their balance sheet, could just plummet. This creates a massive risk of what's called asset impairment, or stranded assets, and that directly threatens the company's entire value.
And finally, let's talk cost of capital. A company that has weak controls around business ethics, think things like bribery or corruption, is just seen as a much riskier investment. Lenders are going to demand higher interest rates, and stock investors will want a higher return. All of this makes it more expensive for that company to raise money to fund its operations and grow.
So when you pull all of this together, materiality, normalization, and these channels of impact, what you have is an incredibly powerful toolkit. And this isn't some separate green analysis you do on the side. This is about integrating this information right into the fundamental models of financial valuation.
And a real cornerstone of financial valuation is the discounted cash flow model, or DCF. The core idea is actually pretty simple. A company's value today is basically the sum of all the cash it's expected to generate in the future. And since a dollar tomorrow is worth less than a dollar today, we discount those future cash flows to figure out what they're worth right now. It's all about making an educated guess about future cash.
And this is exactly where our toolkit gets super practical. We can take our ESG insights and plug them directly into a DCF model. For instance, we might bump up the revenue forecast for a company that has strong sustainable product sales, or we might lower them for a company facing that stranded asset risk. At the same time, we can tweak the discount rate. If a company has lousy ethical controls, its risk profile is higher, which means we use a higher discount rate, and that lowers its present value.
And all of this leaves us with one final thought. For decades, valuation models were built almost entirely on financial data. But as we've just seen, sustainability performance has real, tangible financial consequences. So the question really isn't if these factors matter anymore, but how you're accounting for them. Could this be the critical variable that you've been missing all along?